Hello there, and welcome to a masterclass in getting the right mortgage. This is part 3, credit scores and more. In part 1, we talked about that all-important pre-approval process, getting employment verification, income verification, down payment, closing costs, and of course the do's and don'ts after pre-approval. Part 2, we talked about ratios, gross debt service ratios, total debt service ratios, and the loan-to-value ratios. Today in part 3, we're going to talk about the credit score and how it affects your mortgage. And then, of course, the 5 C's of credit. So again, my name is Steve Lang. I'm a dual licensed mortgage and insurance specialist. I can help you get the right mortgage and then put the protection in place to make sure your loved ones are taken care of should anything happen to you. I do work with Castle Mortgage Group and Castle Insurance here in Winnipeg, a great company to work for with some great relationships with all our underwriters and our lenders. It's such a great group of people. So today, again, we're talking about the 10 steps to buying a house, as we've been talking about in the first couple of videos, and we're talking about still the pre-approval process. So we talked about the down payment, deposit, closing costs. So today we're actually going to talk about the credit scores. So understanding those numbers, again, that matter to you in getting the right mortgage. So your credit score is a statistic-based prediction of your credit risk at any specific point in time. The lower your score, the riskier it will appear to a mortgage lender, landlord, card dealer, credit card company, and more. A person starts with a credit score of 600. At the top end of the scale, the score can reach as high as 900. At the bottom of the scale, the score can be as low as 300. Your credit score is the first tool lenders use to analyze your credit performance. They rely on your credit score and the details of your credit performance when reviewing your mortgage application. The difference between a good or not so good credit score can affect your ability to get the lowest mortgage rate possible. So basically, your credit score the calculation is made up from these 5 elements. The first one, with 35% of the total, is your payment history. So did you make a payment on time? Did you miss a payment? Were you 30, maybe 60 days behind on a payment? Did you forget about a payment? All that stuff goes on your credit score. So when we pull your bureau, that will impact your credit score. The second one now is 30% of this is used credit and available credit. So do you have a credit card limit with a limit of $10,000 and the balance is at $9,000? Well, that's going to impact you negatively. Or do you have 2 credit cards that have a $10,000 limit and a balance of $3,000? Obviously, the second one is better. If you have 2 credit cards with $3,000 split between the 2 of them, that will less impact your credit as if you have one that's maxed out. All right. Credit history, 15%. The longer you've had credit, the cleaner the picture of how you manage your debt. So we're going to discuss this a little bit down the road. But when you get established credit, that's a good thing. Okay. Establishing credit's huge in your credit score. Public records, 10%. Prior history of bankruptcy, that's pretty self-explanatory. If you have a collection issue, if you stop paying a credit card, they're going to come after you and they're going to want part of it anyway. These events have significantly negative impact on your credit score. Now, inquiries, this is a different one. It's only 10%, but it's how often you apply for new credit. So a hard credit inquiry occurs when you apply for a loan, and authorization is required by a lender to see if you're eligible for approval. A soft credit inquiry occurs when a lender checks your credit report for informational purposes. So this has changed quite a bit over the last few years. Now you're allowed to have multiple hard inquiries made within 45 days, and they are generally ignored, as long as they are for the same type of loan. An example is an inquiry from 4 different banks when searching for a mortgage. Now, let's say a car loan and a mortgage hard pull would be 2 different ones, and that would impact your credit score more. Okay, so credit scores, good credit score, 660 to 900 are generally considered good, very good, or excellent. So credit scores from 660 to 724 are considered good, 725 to 759 are considered very good, and 760 and up are considered excellent. Higher credit score obviously means that you demonstrate responsible credit behavior in the past, which may make potential lenders and creditors more confident about your ability to repay a debt when evaluating your request for credit. At least one borrower will need to have a minimum credit score of 600 to qualify for CMHC mortgage insurance. And we're going to talk about that in part 4. So how do your actions impact your credit score? Well, if you pay your bills on time, that's a good thing. Keep your credit card balance well below the limit. Again, a good thing. Apply for credit sparingly. Good. Check your credit reports regularly. Very good. So these are all things that you really, really should be doing. If you have any more questions on credit scores, Equifax.ca is an excellent website to go to find out a little bit more about your credit scores. So most of what we've discussed is the pre-approval process that I, as a mortgage specialist, take to ensure you are able to get the mortgage you want. Now, of course, I pre-approve you, but the lenders obviously are the ones lending you the funds to purchase the house. So they have to qualify you as a borrower as well. So the process of qualifying the borrower looks at two interrelated factors: the borrower's ability to make payments on the mortgage loan and the borrower's willingness to make the payments. Will the borrower honor the mortgage loan's contractual obligations? Well, these two factors are tied together. The borrower has the willingness to pay off the mortgage, just not the income to do so. Or has the income, but wants to spend their money elsewhere, right? Cars, boats, travel. I get it. We all want to have some fun in life. So the 5 C's of credit when applying for a loan is the ability and the willingness of a borrower to pay, and has been categorized into what has become known as the 5 C's of credit. The 5 C's are a mix of both qualitative and quantitative measures that are used by a lender to gauge the creditworthiness of a potential borrower. The system weighs 5 characteristics of the borrower and conditions of the loan, attempting to establish the chance of default and consequently the risk of financial loss for the lender. So here they are. Here's the 5: capacity, capital, collateral, conditions, and character. So the first one is capacity. So this is your ability to repay the loan. Do you have enough income? Are you able to repay the loan when you're asking for money from a lender to lend to you? This is the most critical, obviously, of the 5 C's. Now, remember, you're borrowing hundreds of thousands of dollars from a lender. So they're going to want to make sure that you can actually pay that back. So the second one here is capital. Is the amount of money that a borrower is putting into the transaction and how much extra cash or liquid investment they have, right? How much do you have for a down payment? We talked about that in part 1 of these videos. Now, this is also verified by the bank and investment statement. Now, for residential loans, it's mainly loan to value ratio, right? We talked about that in part 2. So go back and have a look at that one. They want to see skin in the game. So this is you showing them how much skin you have in the game. Now, collateral is security for the lender. Generally, in a non-commercial setting, the default on the loan is you and the principal residence. So the house itself, or an outside party that guarantees the loan. The next one is conditions. So this one refers to the intended purpose of the loan. For example, is it to purchase a home? Right? The loan size in relation to the specified use will assist the lender in weighing your loan application along with economic conditions and outside influences. Today's days of COVID-19, now do you work in a restaurant or a gym? Maybe you get shut down for 3 weeks or 2 weeks or a month, and you might not have any income for that. So this is one of the things that they look at, conditions. So the last one is called character. So it looks at you and how responsible you are about repaying your debt, thus your credit score. So there's no specific way to evaluate character. All they can do is look at your credit score. So things like borrower's length of employment helps determine job security, right? Borrower's propensity to save and use credit responsibly also help to establish credit. So remember in part 1, we talked about time on the job, job letter, how long you've been in the job, how long you've been in the industry. This is one thing that lenders look at, character. All right, so now that's the end of part 3. We covered the credit score and the 5 C's of credit. If you have any questions, please don't hesitate to call or go to my website, stevelang.ca, and book yourself a time in my calendar to go over your mortgage plans. Thanks for watching. Please like and subscribe for more videos, and keep an eye out for part 4.